Look, I need to talk to you about something that's been driving me absolutely crazy on TikTok and Instagram lately. Everyone's showing off their money market fund returns like they just discovered the secret to wealth. I'm getting 4.5% risk-free. Why would anyone keep money in a savings account? This is where smart people put their emergency funds. And here's the thing, they're not entirely wrong, but they're not entirely right either. In the part they're getting wrong, that could cost you thousands of dollars at the worst possible time. So if you've got money sitting in a money market fund right now, or if you're thinking about moving your savings into one because some 22-year-old on TikTok told you it was basically the same as a savings account but better, you need to watch this entire video. Because what I'm about to show you isn't some conspiracy theory. This is basic finance that somehow nobody's talking about. First, let me be clear about why everyone's obsessed with money market funds right now. They're actually pretty great in a lot of ways. As of late 2024, many money market funds are paying around 4.5% to 5% annually. Compare that to the average savings account paying maybe 0.5%, and yeah, I get why people are excited. You put in $10,000, you're making $450 to $500 a year instead of $50. That's a legitimate $400 difference. That's real money. And the financial influencers will tell you, it's liquid, you can access it anytime, it's safe, it's backed by stable securities. All of that is technically true. But here's what most people don't realize. There are three massive differences between money market funds and FDIC insured savings accounts that could absolutely destroy your financial security. And nobody's talking about them because, honestly, most people don't actually understand how these things work. But before we get into that, let me say something really important. Your emergency fund needs to be accessible at the exact moment everyone else panics. That's not fear-mongering. That's just understanding how liquidity works during a crisis. Here's the first issue, and this is the big one. Money market funds are not FDIC insured. Now you might be thinking, okay, but they've never lost money, right? They're super stable. And mostly, yes. Money market funds invest in ultra-safe stuff, treasury bills, high-quality commercial paper, certificates of deposit. The fund aims to maintain a stable net asset value of exactly $1 per share. They're low risk, not no risk. But, and this is critical, they can break the buck. Let me give you a real example. In September 2008, during the financial crisis, the Reserve Primary Fund, one of the oldest and most respected money market funds in America, held $785 million in Lehman Brothers debt. When Lehman collapsed, that fund's NAV dropped to 97 cents per share. Investors panicked and tried to withdraw $40 billion in 1 week. The fund had to freeze redemptions. People couldn't access their money for months. This is extremely rare, but emergency planning isn't about averages. Now, after 2008, regulators tightened the rules significantly, which reduced risk, but did not eliminate it. The structure is safer now, but it's still not the same as FDIC insurance. That's the difference between really safe and FDIC insured up to $250,000. With FDIC insurance, even if your bank literally explodes, you're getting your money back. The full faith and credit of the United States government guarantees it. With a money market fund, you're getting whatever's left after the assets are sold. Okay, here's the second thing nobody's telling you. Money market funds can have redemption restrictions. Look, during normal times, you can absolutely access your money same day or next day. It's liquid. But during times of market stress, fund managers can implement what's called redemption gates or liquidity fees. In 2014, the SEC actually created new rules allowing money market funds to temporarily restrict withdrawals during times of stress. If a fund's liquid assets fall below 30% of its total assets, it can charge you a fee of up to 2% to withdraw your money. Or it can straight up delay your redemption for up to 10 business days. Now think about that psychologically. When would a money market fund be under stress? When would everyone be trying to pull their money out at once? During a crisis, during the exact moment when you need your emergency fund. This is where it gets really interesting because the structure of money market funds creates this perverse incentive. If you think a fund might restrict redemptions, your smartest move is to withdraw your money immediately before everyone else does, which, of course, makes the problem worse. It's not a bank run, it's a liquidity cascade, and it's legal and built into the system. Your high-yield savings account at a regular bank can't do this. Federal law requires banks to give you access to your deposits. That's why FDIC insurance exists in the first place, to prevent these cascades. Now, I should mention, government-only money market funds that invest exclusively in Treasury securities carry less of this risk than prime funds. But most people on TikTok aren't making that distinction. Here's the third issue. Money market fund returns are going to drop. When the Fed starts cutting rates, and they will, your returns will plummet. In 2020, money market funds were paying basically nothing, not 4%, not even 1%. The point is, you're chasing yield in a temporary rate environment. Let me give you a concrete example. Let's say you have $25,000 in an emergency fund. You're comparing money market fund at 4.8%, $1,200 per year, no FDIC insurance. High yield savings at 4.3%, $1,075 per year, full FDIC insurance. You're making an extra $125 per year with the money market fund. That's about $10.41 per month. Is $10 a month worth risking your entire emergency fund during the next financial crisis? Is it worth potential redemption restrictions when you need the money most? For me, that's a hard no. Here's what's really happening psychologically, and this is important to understand. We're in this moment where interest rates are higher than they've been in 15 years, and everyone's chasing yield. That extra 0.5% or 1% looks really attractive right now, but you're optimizing for the wrong thing. Your emergency fund isn't an investment, it's insurance. It's the money that keeps you from going into debt or losing your house when life goes sideways. The purpose of your emergency fund is maximum safety and maximum accessibility, not maximum return. Look, I get it. Watching money sit there earning 3% instead of 5% feels bad. It feels like you're leaving money on the table. But that psychological discomfort is actually causing you to take on risk you don't need to take. Here's how I think about it. Would you pay $125 per year for insurance that guarantees you can access your $25,000 emergency fund with zero restrictions during the worst financial crisis of your life? Of course you would. That's a no-brainer. Well, that's exactly what you're doing by accepting a slightly lower return in an FDIC insured savings account. Now look, I'm not saying money market funds are evil or that you should never use them. For money you're going to need in 3 to 6 months, like if you're saving up for a down payment and you're definitely buying in the spring, a money market fund might make sense. The extra return matters and you have enough advance notice that redemption restrictions probably won't affect you. For business operating cash where you need higher returns and you have multiple layers of backup funding, sure, money market funds can be appropriate. For your taxable investment account where you're parking cash between investments, absolutely, use a money market fund. But for your emergency fund, the money that's supposed to save you when everything goes wrong, you want the most boring, safest, most guaranteed option available. And here's what most people don't realize. You can actually use both. Keep 3 months of expenses in an FDIC insured high yield savings account. That's your true emergency fund, untouchable except for real emergencies. If you want to keep another 3 to 6 months of expenses in a money market fund to get higher returns, fine. Just understand that it's slightly less safe and might not be accessible during a crisis. The key is having that rock-solid foundation in place first. So here's what you need to do. First, look at where your emergency fund is right now. If it's in a money market fund, ask yourself, is this truly money I might need in an emergency, or is this money I'm parking temporarily? If it's your true emergency fund, move it to a high-yield savings account at an FDIC-insured bank. Look for accounts paying at least 4% right now. Marcus by Goldman Sachs, Ally Bank, American Express Personal Savings. There are tons of options. Yes, you might give up 0.5% or even 1% in return. Do it anyway. That's the cost of actual security. Second, stop optimizing your emergency fund for returns. Optimize it for safety and accessibility. Your emergency fund's job is to prevent a financial emergency from becoming a financial catastrophe. That's it. Your investment account is where you take calculated risks for returns. Your emergency fund is where you take zero risks and sleep well at night. Look, I know this isn't the sexy financial advice you see on TikTok. Nobody's going to get views by saying, keep your money in a boring savings account. But here's the thing about personal finance. The boring stuff works. The flashy stuff, chasing yields, taking unnecessary risks with your safety net, assuming it'll probably be fine, that's how people get destroyed during a crisis. Be boring. Be safe. Save the risk-taking for your actual investments. Your future self, the one who just lost their job or had a medical emergency or needs to replace a car, will thank you. Tell me in the comments where you keep your emergency fund and why. I'm genuinely curious if you disagree with this take because this conversation is important. And if you want more realistic financial advice that actually helps you build wealth safely, subscribe to the channel.